Your neighbor drives an old sedan, while the Johnsons flaunt their new SUV and big house. They look richer, but what if that faded car is actually a millionaire's clue? For decades, the American dream was clear: buy a house, build wealth. But today, Bitcoin has changed the game, creating overnight millionaires and massive crashes. So, which really builds wealth faster, a house or Bitcoin? By the end of this video, you'll know 8 key insights to decide for yourself. And trust me, number 8 might change everything. 1. Potential for explosive growth versus steady building. Traditional wisdom says houses steadily appreciate. For example, median US home prices have roughly tripled over the past few decades, which is solid growth. Most traditional investments like stocks or bonds return a few percent a year consistently. Bitcoin's early history was different. It surged thousands of percent in just a few years. If you bought Bitcoin a decade ago, a $1,000 bet could have turned into a small fortune. Meanwhile, $1,000 in an index fund or home equity would have grown, but not 1,000 times. A key difference is risk. Houses hardly ever go to zero. People always need shelter, whereas Bitcoin could theoretically crash to nothing if confidence evaporated. In practice, real estate has a long track record of steady growth, while Bitcoin is still proving itself. For example, Jane and Mike each have $5,000 in 2013. Jane put hers into Bitcoin. Mike used his as a down payment on a starter home. Mortgage covers the rest. Years later, Jane's Bitcoin saw 5 times, 10 times, even 20 times moves, and some crashes, while Mike's equity was up maybe 50 to 100%. Neither ride is guaranteed, but Jane's went to higher peaks and deeper valleys. The key takeaway here is that Bitcoin can deliver explosive returns if you catch it early, but it's a wild ride. Houses grow slowly and steadily. Which feels better to you, the rocket ship or the long climb? 2. Accessibility and liquidity. Buying a home usually means saving up tens of thousands for a down payment, a strict mortgage approval process, and lots of paperwork. You'll deal with realtors, appraisals, inspections, and bank approvals. It can take months to close. It's a major commitment with many middlemen. Bitcoin, by contrast, is very accessible. You can open a crypto account in minutes and buy fractions of Bitcoin anytime online. No credit check, no huge lump sum required. Even $50 a week can automatically buy you a bit of Bitcoin. Need cash quickly? Bitcoin can be sold and converted in a day. Selling a house could take a month or more. For example, Jane might struggle to save $20,000 for a down payment next year, but she can start with $100 a month into Bitcoin while she saves. Those contributions build up silently, even if a house feels far off. The key takeaway here is that crypto is open to almost anyone with the internet. You don't need big savings or perfect credit to start. If you want to get started early and effortlessly, crypto wins. A house offers security and a home, but it takes much longer and more effort to acquire. Paperwork, saving, waiting. 3. Tangible value and use. A house isn't just an asset, it's a home. You can live in it or rent it out. That utility is invaluable. Shelter, stability, even tax benefits. Bitcoin is purely digital. You can't live in it. Its value is speculative. If people stopped believing in it, it could collapse, unlike a house, which still has land and physical value. For example, in a tight month, owning a paid-off house means you have no rent to pay. But if your wealth is all in Bitcoin and the market crashes, you may have to sell some of it to cover basic needs. The key takeaway here is that houses provide real-world benefits on top of investment gains. Bitcoin's worth depends on market demand. Also, houses are illiquid. Selling one takes weeks or months, whereas Bitcoin can be sold instantly anytime you need cash. That liquidity is something real estate simply can't match. Also, owning a house effectively forces you to save. Each mortgage payment builds equity, while Bitcoin gives no such automatic benefit. 4. Risk and volatility. Bitcoin's price is a roller coaster. Big booms and sudden busts. It might soar 100% in a year, then plunge 50% the next. Houses move much slower. Yes, 2008 was rough. Many owners saw 20 to 30% drops over a couple of years, but recovery took years. Compare that to crypto. In 2018, Bitcoin lost about 80% of its value in 1 year. That same drop would be unthinkable in a single year in traditional markets. The key takeaway here is that Bitcoin can double or halve in a year. Houses might dip 10 to 20% in a downturn and recover gradually. If wild swings give you panic attacks, crypto will test you. If steady declines frustrate you, houses will feel calmer. If you're getting value so far, do me a favor. Hit like and subscribe. We keep sharing finance and wealth building strategies like this, and we don't want you to miss out. 5. Ongoing costs versus passive growth. Owning a home brings bills, mortgage payments, property taxes, insurance, maintenance. These eat into your returns. Bitcoin, once bought, has no ongoing costs, aside from small fees if you trade. Its price can grow or shrink without any extra work by you. For example, Sarah's house needed a $6,000 roof repair plus $4,000 in annual taxes and insurance. Those were mandatory expenses. Meanwhile, Alan bought Bitcoin and only paid a tiny fee when adding to his position. No roof needed for his investment. The key takeaway here is that houses come with built-in expenses that reduce your net gain. Bitcoin is more buy and hold. If you want an asset that that doesn't require sweat equity? Crypto has an edge, but remember, you have to secure your keys/accounts carefully. Also note, if you rent out your house, you earn income from renters. Bitcoin doesn't pay rent unless you lend it out or stake it, which is another decision. 6. Leverage and capital efficiency. Real estate is usually bought with leverage. You invest 20% down and borrow the rest via a mortgage. That amplifies gains and losses. For example, $60,000 down on a $300,000 house. A 10% home price rise adds $30,000, which is a 50% return on that $60,000. With $60,000 in Bitcoin, a 10% rise adds just $6,000, 10%. The key takeaway here is that mortgages speeds up home returns and losses on a smaller cash outlay, while Bitcoin is straightforward money in, money out. If you like using debt to amplify results, houses give you that power, but it also means bigger risk if values drop. 7. Social and financial mindset. Buying a home is a deeply ingrained goal in America. It feels safe and fulfilling. Bitcoin is still new and meets skepticism from many. Where you fall on this spectrum matters. Do you trust brick and mortar, or are you excited by new tech? Your social circle and mindset play a role too. If your friends and family all own homes, you might feel pressure to do the same. If your online community is all about crypto, you might feel FOMO by staying out. Are you someone who tolerates slow, steady progress, or do you thrive on bold, fast moves? For example, Mark feels pressure from family to buy a home like everyone else. Lisa reads crypto news daily and can't wait to invest more. Their different mindsets push them to make different choices. The key takeaway here is if you are more comfortable with real estate or digital assets, both can build wealth. So pick the path that fits your personality and goals. 8. Diversification and opportunity. Here's the twist. You don't have to pick just one. Many advisors say diversification is key. You could own a modest home for stability and also invest some funds in Bitcoin for growth. That way you hedge your bets. For example, allocating 80% of savings to a home and 20% to crypto could give you safety plus upside, or vice versa. For example, buy an affordable house with a mortgage and also invest a portion of each paycheck into Bitcoin. Years later, the house might double in value and cover your living needs, while your Bitcoin might have multiplied many times. You end up with security plus explosive upside. The key takeaway here is that the real hack might be using both vehicles wisely. Even if you lean toward crypto, a little property can be an anchor. If you love real estate, a small crypto position could supercharge returns. You don't have to bet everything on one. So here's the bottom line. A house represents stability, practical use, and gradual wealth growth, while Bitcoin is high risk, high reward, and maybe the future of money. If you're over 30 and thinking about your next big move, the choice isn't house or Bitcoin. It's how much of each makes sense for your goals and risk tolerance. Ask yourself, do you value certainty and stability more, or are you willing to risk big swings for potential outsized returns? Here's my final thought. The real winners aren't the ones who blindly choose one side. They're the ones who build a plan, stay consistent, and play the long game. So whether you're saving for a down payment or stacking sats, the principle is still the same. Start today, stay disciplined, and let time do the compounding. If this gave you clarity, let me know in the comments. Would you choose the keys to a house or the keys to a Bitcoin wallet? And make sure to subscribe, because we'll keep breaking down the strategies that help you grow wealth.